Ladies and gentlemen, welcome to the 31st episode of the Futurum Equities Podcast. I got myself, Stock Savvy Shy. We got Daniel Newman. We got a later than usual time slot today, but I don't know.
My fault.
Nobody's fault. I mean, it's Trump press conferences right now, so I think maybe the market's going to be moving. Love being live with you, Daniel, as some volatility hits the market so you can see our reaction to it. But before we get into it, how's your week been? I know it's been a pretty busy one for us on the media front with software is dead. Software is dead. What are we going to do?
Yeah. End of software. It's the end of data centers. It's the end of memory. There's no more memory. It's the security meltdown. We don't have enough cyber, but nobody wants cyber. It's each day it changes. But yeah, you were in New York crushing it on the airwaves. I was remoting in. Had quite a bit of media as well. We were busy. It was a busy week. But yeah, I noticed now that SoFi is down under 20. I'm no longer Danny Dimes. I've lost it. I'm Danny.
You got to earn that title back. No, I mean, listen, I'm bag holding on SoFi. I'm down like 20 something percent, I think, on my SoFi position. I don't know what's driving it, but all I know is that
obviously it's very influenced by tariffs and data center buildouts. In Bitcoin.
I do think SoFi really separated themselves from the fintech group this cycle because every other fintech name that showed the cyclicality risk in their business models. Like Robinhood, clearly, they're still heavily exposed to crypto transactions, crypto winter. You saw Pagaya Technologies show a big miss because they don't want to really have those credit risks on their balance sheet. There's a ton of other names as well where SoFi was insulated from all that cyclicality. On top of that, Noto feels like he's turning a new character change in his style of being a CEO, where he's being more vocal about what he thinks the growth is going to be, and he's also taking some more non-legacy media outlets to communicate this. So that's a great thing for shareholders. But either way, I mean, I think he said something about this recent earnings growth the guide is going to be the minimum case of what the guide's going to look like the rest of the year. It's just crazy numbers that SoFi's reporting, but you're essentially getting the last two earnings reports for free because of the pullback they've seen. But I don't know. Have you been adding
that and the dilution?
Yeah,
I think they shared some details on the dilution and how it's being utilized, and effectively they're arbitraging with that capital raise, and so I think it's just a patience thing. I still think S&P inclusion comes this year. And by the way, I didn't mean to totally go down the SoFi rabbit hole. I was just laughing because I'm no longer Danny Dimes, so I'm growing up. But when a piece of your portfolio that large pulls back that much, you're just a little bit less of a person at that point. Annie Nichols. Yeah, there you go. Annie pennies today. So, but I'm making all kinds of crazy bets, but so far my some of the plays, I love volatility. I love options plays on volatility. So I don't always go long into it because I'm never quite as certain as to when things are going to change, but I'm generally certain about long-term value, especially with good companies, where if something falls incredibly fast, that creates so much option volatility, and option volatility creates so much income opportunity. And so I do like it, but I guess there's these two stages. There's the volatility stage where things are moving sideways and there's lots of kind of different ways you can play the market. And then there's everything's up a lot and you just love looking at your balance and you just love, you don't really want to buy because you're it's so expensive. You're I
know,
so you want to help your position. So, but yeah, I mean, it's funny. It's a lot of sideways, a lot of AI trades moved sideways or down. Software's gotten crushed. Crypto still down a lot. You're still seeing a lot of these rotations. You still got 50 times forward on Costco and Walmart. So there's still these kind of anomalies in the market, and $650 billion in capex that's going to go 40-50% to NVIDIA has largely not moved it at all. Price. So,
well, I think it's interesting. That is a new theme in 2026. Why is Costco, Walmart, John Deere, Coca-Cola, all these companies who have no growth, they have a premium valuation on their earnings multiple all of a sudden. And I think it's somewhat of a good conversation to have, because I think there is somewhat of a heartburn that the market's showing you of all this AI infrastructure spend, the disruption that AI is supposedly going to have for every name possible. When the companies are outperforming this year are the ones that have physical assets that are completely excluded from the AI trade. And I think they're offering somewhat of a safe haven. I think that's why Apple's performing so well among Max 7, because they are obviously not participating in the CapEx race for AI, which you and I both disagree with. Like, they should absolutely be participating, but they are being rewarded by the market because they don't have that overspending risk. And I think right now the market is just being so irrational between two extreme forces. One force is they're spending an arm and a leg on something that there's no proven ROI yet. Ridiculous. The other extreme is it's going to be so disruptive and so impactful, nobody's going to be buying these products, and it's going to eat up society. Those are two massively different extremes that are happening at the same time. That doesn't make sense at all. It's either one or the other. It can't be both. So I do believe that the market's eventually going to fall in between these two extremes. However, I don't know when that's going to be revealed, essentially. It might be an extended period of time, especially when you have $650 billion of CapEx, like you mentioned. Like, there's going to be no earnings growth to match that level of CapEx increase this year. And there might be a prolonged period of digestion until they get enough compute possible, so they're not as constrained. So you can really see the ROI working for these AI expenses. And it might not happen for a couple quarters. And I think that is new behavior, because anytime there's been somewhat of a massive pullback in the market, it's been a V shape. It's been short-lived. It's been Black Swan-y. This is not Black Swan-y. This is more, I just had a full steak course dinner and I need to get some Pepto-Bismol, relieve my heartburn from just overeating. That's going to take an overnight sleep, essentially. I don't know. What's your take on what's causing this like ruffle among AI infrastructure names?
Well, I mean, you saw the news today, like, what was it? CoreWeave and the Blue Owl deal.
Yeah.
Things like that popping up. And these are then immediately they become structural questions. Is this a problem for CoreWeave, or is this a problem for the whole, AI data center build out trade? We saw this a little bit with Oracle for a period of time. Like, what Oracle was going through is what Oracle going through going to be the same thing that Google and Microsoft and Amazon experienced. And I think over time, they were cutting the wheat from the chaff, that they saw the risk to Oracle is much more specific than the risk to the others. And while the others didn't run, they also didn't get nearly the same sort of pullback. And now I think with CoreWeave, there's a bit more of like a fragility around a lot of these sort of AI GPU REIT names. You look at Ciphers, the Irons, the Hut 8, the Bitfarm. Like, people, I don't know that they feel they have the same amount of capital stability, ability to raise funds, despite the fact that they have very successfully. A lot of them have raised funds recently. But I think people are wondering if it's structural, if the concerns are more significant. Like, I look at CoreWeave as unique because I think CoreWeave has a very unique debt structure. They've had to raise a lot of capital, and despite growing really fast, the way they handle depreciation of their GPUs, the way they utilize the assets on their balance sheet for borrowing purposes, like, I think they have a unique structure, not just structural structure to their financials, that makes them more difficult than, say, a Nebius or, say, a Cipher. And so I do think it's a little bit of we can't throw the baby out with the bathwater here, because I'm still not seeing, I think OpenAI's $100 billion is going to get announced official. It's coming. It's imminent. We saw the Anthropic raise. The private market is not pulling back valuations at all. We've seen the 100-year debt raise from Google, the oversubscription of all the debt raises from all the hyperscalers. Like,
Yeah.
I think their risk is unique. I don't think I think people want to make it something. I don't think it's something.
They shouldn't. And I think that we've been very vocal about CoreWeave being, or I've been maybe a little more aggressive than you, but I think they're the bad agents of this AI ecosystem on what can go wrong. And I think that's very specific to CoreWeave, like today's action. I think Blue Owl is making a rational decision, maybe, of just slowing down a bit and seeing where the ROI is going to come when you're investing that much money with a startup. Because end of the day, CoreWeave is still a startup. They are not profitable, and they are getting very creative, like you mentioned, on funding these deals, and you just don't know what's going to look like down the line. So I think whatever pain on CoreWeave on this deal, it should not be read through on what the AI demand is, because like you mentioned, if you want proof on what the real demand is, look at the oversubscription on the biggest players in the game. I think I put CoreWeave in the tier 3 category of players in this AI ecosystem. I wouldn't, anything that happens to the tier 3 names, I would just like ignore for the total AI demand picture. And what I mean by, if you want like top of my head, like obviously the hyperscalers are tier 1. I also think that tier 2 are the names like the Nebuses who can self-fund themselves. I think they mentioned 60% they can self-fund themselves. That is clearly a tier 2 name. I think you're seeing Cypher have the de-risk a bit on their landlord approach. I think Iron has that economics to make it really work. We need to see the deal. But like the other names that are very crowded, that are pivoting from Bitcoin miner to AI data centers, I put them all in tier 3 with obviously the big risk in CoreWeave. But whatever CoreWeave doesn't fulfill, I think it's going to get fulfilled by the big 4. And until we see the demand cracking, like this is just all noise. And I don't love to see Nebius down 10% off this news. I think that's an overreaction, but it does create opportunity. I just wish I had more cash. Like I'm adding 1% cash position every week. Hopefully it builds up to 5 or 6. But as of right now, remember that level we talked about last week, Daniel? The 21-week EMA level is everything. We are pinned to that level again. Even all this volatility, we're at 606 right now. It's like we need to close above this level for there to be somewhat of a relief of like the short to medium term is going to be okay. Maybe we don't get there until NVIDIA's earnings on Wednesday, but I don't know. I think it's interesting times. I do want to talk about. Actually, you're going to say something?
No. Good.
So next week is one of those like. Hopefully you have a seatbelt on type of weeks in the earnings cycle. I don't know. Did you get a chance to see who's reporting next week?
NVIDIA.
I can talk it over. Easy one for NVIDIA. Yeah, you're right. But
is there anyone else in an NVIDIA week? Is anyone else reporting when NVIDIA is reporting?
It's so valid.
You see how I do that, right? Every quarter I take the earnings whispers thing and I black everything out but the NVIDIA and I say next week's reports. I'll tweet that out later. It's like a quarterly joke for me because like when they report, like everything else is like, so, and I obviously, if you're an individual investor in any other name, but the entire market sits back and waits for what NVIDIA does. If they falter, it doesn't really matter what anyone else does.
Well, spoiler alert, it's going to be a really strong earnings. We saw the big 4 CapEx increase. I think the commentary is going to be really big on the conference call more than actual earnings report, in my opinion. But going over for all the individual investors out there, I agree. It's NVIDIA or bust next week, but it's a crazy one. Monday, we got Hims and Her Health reporting after the bell. That is becoming a battleground stock a bit right now in their recent pullback. Then we got, Mercado Libre on Tuesday. We got Cypher Tuesday morning as well. We got DigitalOcean Tuesday morning as well. And that's been our favorite name that we've talked about for as long as this podcast has been out. That is gaining popularity. So like the bar has never been higher for DigitalOcean to actually produce what we've been talking about, which is that 20% growth, reacceleration, and picks and shovels winner of this low-cost, durable cloud computing company in the agentic AI world. But I think software is going to be at play. I think we got ServiceNow a bit. We got some commentary on ServiceNow and showed that doesn't matter what you report, it might not move the needle, and doesn't matter what the management does, which is like Bill and team. Like I do want to applaud Bill and team for what they did. I think it's so easy for these CEOs to constantly talk about AI is not disrupting software. Software is going to be fine. Software is going to be fine. Blah, 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 blah. There's been no buying from insiders in the software space. Wow,
it's brutal.
But Bill, he bought $3 million open market, and the whole management team is like we're just going to stop with your sales
They
plan.
canceled all their sales, which, by the way, it's noteworthy. Like, they're not selling actively; they have planned sales. So a lot of the executives are on SBC, which means they only make X in cash, and a lot of their upside is all in stock. So they regularly sell stock as an augmentation. They usually plan these months in advance, if not further, and that's how they actually incrementally increase cash. Since stock is great to have, but it doesn't necessarily pay your bills. The fact that most of the management team came together and said, we don't want to sell. First of all, it says two things. One is we believe we're undervalued, which is an important signal. It's a better one even than buybacks. It's like one thing when the company buys back with its own money. It's another thing when people are saying, I'm going to defer gratitude or defer, what the heck's the word I'm looking for? Defer cash in this case, right?
Yeah.
In order to maybe get something long term.
No, it's everything. I think I was very impressed. I was disappointed that the market ignored it. I was like, it is what it is. So I think it was great. And I think I diverged at that. I just wanted to acknowledge how incredible management Bill is for ServiceNow, and that once we get past this narrative of AI will kill software, I do believe that ServiceNow will be one of those like misread plays looking back in a couple of years. But it's also interesting because I don't know if you got a chance to look at any of the media. I came up with this like legacy layer test that I think every investor needs to ask themselves if you're a software investor. And you have to ask yourself these three questions. Three questions are essentially if AI will eat you up or you're going to survive and thrive in the AI economy. First one is obviously the most common one for everyone. Are you a seat-based model living in a world where AI agents will reduce knowledge workers? That's the most obvious one. Everyone and their mother has been saying that's a disruption. I agree with that. That is a disruption that you're going to see a lot of names pivot away from. The second question is your product purely digital or does it actually touch the physical world? And I think that if it's purely digital, you are going to be at risk of AI becoming a major competitor for you. That's why I believe that the Palantirs of the world, the orchestration layer, like their product touches the real world. In the war place, they affect war, they affect the logistics, they affect so much of the real world. That's why they benefit substantially from it. Same with security. Security on devices, that's the real world. Cloudflare, they have all the physical those massive towers, which helps them connect all the devices towards the edge, which is why they control 20% of the internet. So that's an example. So that's the second question. Is your product purely digital? Third, this is probably the most important one. Do you actually own the data that AI agents can't generate? That is the big question. So if your software company falls for each of those three questions of they are seat-based model, it's purely digital, and we don't own the data, you are at risk of becoming the legacy layer of the new agentic AI stack. And do you have anything else to add to that test?
If you're a feed, if you're just a zero copy of other data, and you're just some sort of substrate or some sort of like semantic layer that just sits on everyone else's stuff, that's gone. It's going away. That's
90% of software, by the way, guys. That's a lot of software.
Yeah. It's again, if that data can be accessed, it's a great way to think about it. Ask the core data that's used for that application. Where is it and who owns it?
Mm-hmm.
Because if it's available in the open internet, there's not a zero value. Like there's companies like AlphaSense that have built these like interesting data aggregation layers, but they're APIs. They're basically, their business model is going to be a call, like some other software, like an Anthropic. You're just going to pay a little bit of money to actually be able to access what's behind their firewall. If it's organized in a way, and by the way, over time, as the database and the ability for AI to read schema better, and it gets better and better, it will increasingly remove the moat.
So I'm really happy you brought that up, because what I mean by like, if it qualifies for all three of those questions, I'm not saying it's going away. I'm saying it's going to become a commodity. We have a perfect example of an incredible business that eventually became a commodity and what the valuation the market is willing to price that commodity. PayPal, very different business, but payment services and is a commodity these days. And PayPal's huge mind share, Venmo, etc. The market's pricing them at 6 times earnings. So what I'm saying is, if a software company, they're not going to go away, but if they qualify for all 3 of those questions, they're probably going to be trapped between the 5 to 8 times earnings for multiple. And I think if you're an investor trying to capitalize on AI, why are you trying to catch a falling knife that's going to become a legacy valuation that's 5 to 8 times earnings? You're not going to try to do that. So especially when Dano and I have been like saying this as well, where we think IT spending is going to drastically increase in the next 5+ years. So connect the dots, guys. If 90% of software is going to start getting devalued to become the legacy layer, where's all that incremental spend that's going to go towards? All the AI native customers right now, and also the names that the 10% that actually proved they will be winners. So that 10% is going to obviously start having a scarcity premium, because a lot more flow is going towards those names rather than the legacy layer. So I think it's really important to be taking your emotion out of this, because this re-rating is real. I disagree that all software should be treated the same right now, but we're at the phase where market sentencing everyone. Then they're going to ask questions later. That's where the opportunity lies. But it's important to go through that exercise for each of these names. And I think,
by the way, a lot of retail has poured back in. Retail's been buying software like crazy, buying the dip. And I think it's important that, that people listen and take what you're saying seriously. Is do not make the mistake of thinking buying all software is a good idea.
Yeah.
Do your homework, pick the winners, answer those 3 questions. Plus, Mike, basically understand is the foundation in which this software sits on top of. Basically, I like a simpler question that you asked. Is it mission critical? Is that software mission critical to a business? If it is, there's going to be a lot harder to rip out. Like ripping out an Oracle or an SAP. By the way, a lot of people might want to, but it's like it will completely decapitate a business. These businesses depend on these capabilities. You go up and downstream. Like if you rip out the project management tool and build something else, or you rip out a certain HR tool or something, will it cause that same kind of pain? And if the answer is no, then I would say steer to the ones that absolutely cannot function without that software. And there's also, like I said, a lot about, I look at governance a lot. Like, do these particular softwares, are transactions flowing through them? Dollars? Because that's also another big thing. Like, people don't mind using an AI tool to help with a content creation, marketing, SaaS workflow or something like that. But are you going to actually transact on that platform? Meaning money moving from across borders, taxes, literally corporate governance, our legal filings crossing that platform. Like things like that are not going to just get blown up quickly. Yeah. There's too much risk.
So I mean, what you're saying essentially by this, which I agree with, is like we are still in we're in the deployment phase of AI, but still somewhat experimental. So like if you're not going to trust some AI company that got started yesterday to touch your ERP system, because if something does go wrong, they haven't had the experience or time to test the thousands of bugs that, I don't know, like an Oracle has done, or even a Salesforce has done. So there is somewhat of a advantage in that, but these companies do have to make sure they make the necessary moves to fit what the new AI economy is going to be, because you can't just latch onto this system of records advantage, because eventually that's going to erode, because AI is just becoming better and better and better. But as of right now, and probably for the foreseeable future, for the next couple of years, you can't just trust this AI native customer to touch your ERP, because God forbid something goes wrong. You can't say, oops, sorry, AI did it. That won't work as a response to these clients. So it is very real.
Spilling data, and don't forget security. Security in government's it's not trivial.
Well, I actually have a question for you, because I heard this, Chamath said this, and I was like, I disagree with this take, but it's a really interesting exercise to have in your head. Is the reason that maybe a lot of these cloud stocks, software stocks are struggling is there might be a full circle moment with going back towards on-prem. And I think there is always leakage if you're on the cloud, like it's almost 100%, but there's somewhat of leakage. Do you want to risk your sauce that you have in AI that your competitor might be able to extract from through that leakage? Or do you want everything on-prem protected and you're willing to suck up the margins in order to do so? I disagree with that, but curious on your take on that.
Well, I think there's some arguments for prem. I mean, first of all, if you're a large enterprise and you're doing a lot of token generation, like you're paying a premium. So if you can build your own AI infrastructure, run your own, some of your own inference on your own infra, if you have scaled applications, there's definitely a case to be made for being your own token factory. So I think some big companies will run inference on prem, because I think you'll get good economics when you start, like, think about what agents at scale, like what we're going to spend on cloud. It's going to get expensive. I mean, this has been an argument as old as time. Like, there's been little indicators over time of workloads coming back on prem, but it just has never quite manifested or materialized the way the stories are. Like, everyone's going to, it's like, I don't know if people are going to want to build out a lot more. Like, I think large companies do this, like they can do the economics on prem versus cloud. But I think of these businesses as they're trying to get lean and efficient. The cloud just gives such great consumption economics in terms of like, I just think that you really have to be a fairly scaled business with very specific talents and resources to make it make sense to build more infrastructure on prem right now.
I like that. That makes sense. I mean, I was trying, because the reason I'm trying to pinpoint this is like security stocks, like cybersecurity stocks have gone beaten down to an extent where it doesn't make sense on this AI narrative. So it's like, is there something else underplaying this? So maybe it was the on-prem thing, but yeah, I agree. It's more of a hyperscaler might do this, but I think a lot of the SMBs of the world, medium-sized companies will not. But it's an interesting exercise to play. Next question I think we should talk about as well is Palo Alto, because there was a very big divergence between what the street was expecting on guidance and what was actually produced. What was your takeaway from Palo Alto's earnings? Because I know you and I both talked about this during our media circuit this week.
I mean, Palo Alto, first of all, this is a company that's trading at multi-year lows right now. And so I struggle with that valuation based on its accretive, there's the accretive nature of CyberArk and other deals that it's done. Mm-hmm. It's built such scale. And I think that scale is really, really going to be important. Think about like OpenClaw or CloudBot, Moltbot, whatever it is. Like, think about all the security vulnerabilities that are being brought in as people are trying to race to agentic capabilities in their enterprises. Every agent is like a badgeless, nameless, faceless employee with endless credentials and access to tools that can get into the system. Like, yeah. So everything from perimeter to cloud to AI sort of security feels like such a big opportunity. Yeah. And so it's one of those where the market is clearly not rewarding this trend yet. It does not fully appreciate it or see it. I don't think AI is going to eat cybersecurity. I think AI is going to accelerate the need for cybersecurity. Mm-hmm. So then the question is Nikesh Arora, the CEO's master plan of being a acquisitive super platform, the route? And the bet is basically, can he bring synergies out of all these companies he's kind of strapping and bolting together? And so, the numbers, the guide, people didn't love it, but like, I think he outperformed what each of the two individual businesses were estimated at in the combined, but it just wasn't by enough. But I think it takes more time for the synergies to come out. I still like the trend and like Crowd, Palo, and then like the Googles, and to some extent, like on the enterprise side, like the Cisco's. There's only a small number of players that really have these kind of full stack security offerings, and I think the market needs more consolidation. Security is too fragmented.
I agree 100%. It's just,
but I think there's some patience. I think you have to be patient. I don't see this thing running up anytime soon.
No, I think it's in the penalty box a bit. And I think I was trying to think about past instances where the acquisitive model at this scale has worked out. Like, I think a lot of people are very worried that this is Salesforce 2.0. And what I mean by that is Salesforce obviously went down this
bolt on.
And now they had a couple errors, large errors, and they have $50 billion in goodwill sitting on their balance sheets. That is dedicated to companies in the old world where maybe it could have gone towards what the new AI economy is going to be. There is somewhat of a fear of like you make these large purchases. I agree with you. I think CyberArk was a steal. I think CyberArk probably made the mistake of selling out when they did, because the agentic AI moment was just had 2 months ago, and machines are going to outnumber humans 100, 200 times to one. And that's going to be huge for identity. Like you mentioned, like every AI agent's a device that just you can't track unless you need identity associated with it. So I think that the worry is it wasn't just CyberArk. They spent Chronosphere was $5 or $6 billion, and they had another one. I think there's been like, if you continue make these acquisitions multiple times a year, there's going to be obvious synergy risks, and you can't hit 100% on all of them. Eventually, there might be some duds that are going to be anchoring your margin expansion, and that is a worry. But the theme is super strong and has a lot of legs in the runway. And if you want Palo Alto to become this network security platform, they kind of need to make these acquisitions because they came from a hardware lens and trying to become more of a cloud lens. They are succeeding in that, but it's going to take some time. So I do think that Palo Alto is one that's trading at 30 times free cash flow, for example. Like, it feels fair for the amount of noise that earnings report had. Like, I think that pullback was very fair. You have to wait.
It's like multi-year low. It's a multi-year low with all the accretive value of the acquisitions. So it's you're getting kind of like the CyberArk deal for free right now. If you liked it before, you're kind of getting it like it's included in the price.
That's a good question to ask yourself. Like, is it fair to pinpoint to the pre-agentic AI world valuations now? Because there's always going to be somewhat of a risk now if AI is just going to disrupt everything. Yeah. I disagree with it, but there might be a philosophy on that.
I've not seen a sign yet that AI will. I mean, by the way, cyber has been trying to use AI for a long time to, I guess AI is moving faster and agents are moving faster, but like using AI and ML tactics to identify cyber fraud and stuff has been being done for decades, like literally like more than a decade. So it's not like just a new thing like AI and cyber. I think you have to basically, I think you made a good point about kind of thinking about consolidation and picking winners. What I do think is coming out of this AI trend is industries that maybe could have 20 or 30 names that were highly performant, like in SaaS, might be 5. And in cyber, it's kind of the same thing. Like where, in some of these industries, like we are going to get to the point where there's going to be like the leader, there's going to be like the second, thirds, and then there's everyone else. And, in some of these industries, they enjoyed having 20, 30, 40 names that could all perform, all keep growing, all keep going up. And I think fragmentation is going to trade for consolidation in cyber. And so it's basically, are you picking crowd? Are you picking Cisco? Are you picking Palo? Are you picking like a hyperscaler to build more security in-house, like a Microsoft, which by the way, the largest security company in the world, Microsoft.
Yeah.
Are you picking someone there? And that's where you want to put your dollars because you don't see cyber as an independent platform. You see cyber as a baked in capability that sits inside of a broader platform play. And those are the questions you really have to ask.
So I think that framing is so accurate what the future is going to be like, because I think that the distribution is going to be insanely uneven going forward towards the clear winners and everyone else. I think you're seeing that. You're going to see that in enterprise IT. You're going to see that in cybersecurity. You're going to see that across the board where there's going to be even more insane premiums, and then everyone else is going to be trading at multi-year averages. And I think if you're caught in between, that's the risk. Like, I think that CrowdStrike, I saw one of the questions here, like, what's your, which cyber stock is your number one pick? For me, it's been CrowdStrike because they've organically proven to be able to create their own additional modules past couple of years of the latest and greatest through the Falcon platform. Yeah, they had a huge slip up on shutting the world down for a couple hours years ago. But George did an incredible job getting himself out of that hole. And I think now they're about to finally get out of that fundamental hole because they still have to pay for the credits from that mess. I think they're positioned really well. And I think that next one for me, we haven't talked about this too much, Rubrik. I really do believe that AI agents, there's going to be millions of always on AI agents that are going to be continuously operating autonomously. I think it's really important to have that undo button, essentially, for these AI agents if something goes wrong for these attacks. Like, you need a data vault. I'm curious on your thoughts about Zscaler, because Zscaler is one where I don't know if it can be a full platform. I love how they fit in the cybersecurity stack, but it is hyper. Like, if you want to talk about fragmented niches in the ecosystem, what Zscaler operates in is highly competitive, and I think they have they're not all public, and that's the tricky thing about Zscaler's competition. But it's super competitive. But they've gone destroyed, but their fundamentals are great. So what's your take on Zscaler?
You know, I don't know if they're going to they become too niche. Risk of being too niche. I'm not sure they have the platform scale. You know, it's why I kind of, like I said, when I was coming, I forgot about them even when I was naming names just a minute ago. I feel like they're going to either get acquired or kind of sucked into something, because what I think is, you know, right now, and by the way, this isn't in terms of businesses, you know, business survival. I'm just talking about in terms of investability. When I look at investability, like, I really want broad platform. I want agents. I want AI. I want cloud. I want, you know, scale. I want to be thinking about, like, are you the type of security offering that could basically be the core of an enterprise's security strategy? Mm-hmm. And if you're just serving one purpose, like, you know, endpoint security, you know, like, I get that there's a business for you out there. I just don't know how investable you are. So I think that's kind of what I'm seeing with some of these names that don't have sort of what I would call either a current or at least a pathway to being sort of full stack.
I agree with that. No, I agree with that. I always thought that the perfect marriage is, perfect marriage is Zscaler and CrowdStrike is the perfect marriage. I just don't think that Zscaler will ever sell out, but I don't know. Like, also another point is, like, Microsoft right now, I'm looking at the chart. They're trading 22 times forward earnings. That's their 7-year low is 21 times earnings. So we talk about pure play cybersecurity names all the time. Microsoft has the best cybersecurity product in the world.
Largest.
It's the largest as well. So, like, it's difficult when you can buy that business for 7 times near their 7-year lows.
And that goes back to my kind of point, though, is like, when you like a theme, you got to pick how you get exposure to the theme.
Yeah.
It's like a lot of people want exposure to robotics, but it's like, I can get exposure with with Elon Musk by getting into Tesla, as opposed to picking something that's maybe much more specifically like a true robotics company. And what I'm saying is, a lot of the Mag 7 type names can give you the exposure. Google's got some serious security exposure. Microsoft has serious security exposure. So I think right now, especially when some of these names have pulled back to, like you said, to multi-year lows, it's hard to weigh against that. It's hard to get narrow and go niche when you can actually get the broad theme, especially when there's not real clear upside, meaning, like, you're not really if you're not super confident that there's going to be that winner. So in moments like this, I like that idea. I mean, you know, like a Microsoft right here it's had the crap beaten out of it.
It's the Sam Altman effect for sure. That just shows it to you. When 45% of your backlog is open AI, I think the market's kind of penalizing for them.
But your backlog's twice the size, by the way.
I know. It's essentially their backlog is showing everyone that they have like 5+ years of revenue already recognized for Azure. It's kind of nuts to think about it that way. But I do want to bring up NVIDIA earnings, because I want us to give us our commentary ahead of that, because that is the Super Bowl of every earnings cycle. And I think this one specifically, NVIDIA stock has gone nowhere for 6 months. And I think there's a lot of spreading of FUD that's probably impacting them. Maybe Google's TPU success is being used as a zero-sum framing on why NVIDIA shouldn't be catching a bid, which is ridiculous. But for me, I think everyone's going to be watching this name. I think everyone's going to be, for me specifically, I'm going to see how Blackwell is ramping. I want to see what if Jensen provides more commentary when he was like preparing the chips the world has never seen before. It feels like he might be adding some more commentary on
little grok in there. Little grok.
Yeah. The grok. that Grok would be big. I would love to see Rubin timing as well on a 2026 roadmap. Like, I think there's a lot of gems that could be found.
I think Evercore came out with a comment saying they think it might be 3 to 6 months forward, cold forward.
I saw that. And there's just so much misinformation, though, out there that I don't know what's real. That's why I want to hear Jetson say it. But that'd be a game changer, to be honest. Like, that's a big change. 3 to 6 months. Like, that time window is what's the time window from Blackwell to Rubin now? If that happens, it's like all-time low of like,
to be like a 9-month cycle. It's wild.
Crazy. That's crazy.
The early production.
It's just so nuts to me. And that, again, like, I do believe that it just shows how they're so different than everyone else. NVIDIA, like, they have so many, they can offer so many system solutions to everyone else that nobody else can offer, that it's like we're all living in their world. But what's your take? What's your pre-earnings thoughts that you want to share to everyone?
Yeah. So couple things. I mean, you hit it on the head. I mean, the ramp and Rubin visibility is going to be really important, but I think he's proven that he can keep the train on the tracks. He's bought the memory capacity. He's bought the wafer capacity packaging. He's ahead of the game on all that stuff. The Meta deal, by the way, what a win. I mean,
oh my God. Yeah.
It's not zero sum with AMD. And so people, please stop thinking that just because they won something means like AMD's out. It's not. But it was a big win. And Jensen is absolutely, brutal about like going in and just taking all the market he can out of every deal. I mean, he's great. I mean, God, you should want him on your payroll if you can get him. But you can for about $190 a share. The margins will be important, Shay. I mean, everyone's watching. Can they creep the margins back up? People keep saying the margins are going to get hit. They haven't really. I mean, I think they're going to expand. I mean, the consensus is like around 73.5%. The data center revenue up 66% is expectation. I think they're going to beat that. I think it's going to be bigger than even what's expected. I remain bullish there. There's some other things that they could tease that I think would be interesting, like China. I mean, we saw some China flow into the numbers from AMD. Are they going to get a little bit of a surprise tailwind from China? Then, of course, the sovereign AI trend. Like, they've talked about that in every quarter, but no real numbers. Like, are we seeing data centers being built all over the world? Like, big, meaningful shipments of data center going beyond the hyperscalers? Because we know that the hyperscaler numbers are super predictable, but are we seeing any trend lines? What's going on in the Middle East? What's going on across Europe? Where are the build outs happening beyond? And of course, we'll be super interested in the guide too, because the guide is all about the durability here. We were pretty sure this one's looking good. The CapEx suggests the next few, but what's he going to guide out after with the year? Because this is the end of Q4 for them, right?
Yeah.
So he's going to be, he's going to talk about what he sees for the full year next year, which could be very exciting. But I think it could be like the moment where we get a bit of a turn here. Like, again, if OpenAI announces their $100 billion and it happens and NVIDIA just absolutely crushes it, it just takes more air out of the whole bubble bear story. The whole bubble bear, it's all going to implode. Like, no, there seems to be the capital keeps coming. The buying is pervasive. The data centers are going up. Yes, there are little fractures in the systems because one person forecloses their home doesn't mean everybody's going to go into foreclosure. And so it's the same analogy here. There's going to be some bad debt. There's going to be some bad deals. But I think overall it's going to be in good shape.
Yeah, I think it's going to be a strong one as well. And hopefully it's what's going to make the narrative change on this AI infrastructure trade that's just obviously been on pause. Let's see what else is reporting. I'm curious. Another big one for me, because as many of you guys are aware, I'm a Snowflake bull. They were reporting on Wednesday, same afternoon as NVIDIA. This is like they do this every single quarter, and I just never understand why that is. It's just ridiculous, in my opinion, to be a company that's an AI reporting the same afternoon as NVIDIA. I know it's like not their fault, but it kind of is, in my opinion. You can obviously adjust it when you see weeks ahead of the advance, just 1 or 2 days. But That's a big one for me because I do think that I'm bullish in the name. But if you go back to the legacy layer test, like one of the three questions is your product purely digital? Snowflake is purely digital. I think the data platform is an incredible angle on the new AI economy, but there is a massive walled garden approach with data platforms. And I think you can get a lot with AWS's offerings. You get a lot with similar like hyperscaler offerings out there. And I think that Snowflake has had a Databricks problem for a long time that won't go away anytime soon because they can't compete with the margins that Databricks has in the private markets when they get underpriced. And Databricks was launched with an AI lens when Snowflake just pivoted recently, successfully pivoted from data warehouse to the AI data platform lens. And it's not the same advantage. So for me specifically, the things I'm looking for in Snowflake is not for a beat, because I think they're going to beat. I just think that we need to see reacceleration on key metrics. Like the reason Cloudflare was able to catch a bid during the cycle when almost all other software names weren't able to is they proved that RPOs are reaccelerating for 3 straight quarters. Like they went from 35% growth 2 quarters ago to 39% 1 quarter ago to this cycle. They went to 49%. So I think that this is showing clear signs of reacceleration. I think for Snowflake, they've been pinned at 125% NRR, net revenue retention. They need to show a reacceleration of that because last cycle, they didn't really have a reacceleration at that level, but RPO bumped up from 33 to 37%. So that means that they're signing a lot of large deals, but some reason the deployments or the workflows aren't being deployed at the scale that it should be. So that to me is somewhat of a disconnect. I think they kind of need to be more aligned for it to catch a bid. And I'm excited for this one because I do think this is one of those names that might get that scarcity premium I'm talking about of being an AI winner. When right now, they are trading at, let me pull up, it's still not the cheapest, which is kind of crazy. Even after this pullback, they are trading at 43 times free cash flow. And they have an SBC problem. So like it's not really, they're not profitable. So they actually have to be showing growth numbers. And they need to be growing, I don't know, 30% for to be satisfaction in the market. Do you have any specific take on Snowflake?
I have to spend some time with their CEO. I mean, they do have an SBC challenge. I do think they have a good AI pivot story. I do think that data foundation layer is still really important for enterprises to be able to put AI to work. I haven't looked at it as closely, like to see if it's, its trading levels and stuff to have a strong opinion on kind of how investable it is here. But I still think that what they are, and basically it's a kind of a couple horse race. Did I lose you?
No, I'm here.
Sorry, my computer just went black. It's back. It's back. So, I think you covered that one well. I am looking at the whole list though of what we've got next week, and it's going to be a banger of a week. I mean, all the jokes aside, I'm kind of looking at what I'm going to look at. You got DigitalOcean and Cypher on Tuesday before the market. We've got I know you like Mercado Libre.
Woo!
You got Axon, you got Zeta. Zeta's an interesting one. I know we've got a lot of questions in the comments about Zeta. I like Zeta because it's been like a real world AI ROI case. Like it's a company that really is putting AI to work. And if you can put AI to work and create marketing scale, it's measurable. Workday, people will be watching that. Another SaaS company that's been beat up. Tempest is a disruptor in the AI healthcare space. Both you and Nancy Pelosi, I think, like it. HP, I mean, God, did they buy enough memory? Are they going to be able to keep up with PC demand? Their CEO left. They've had a lot of big movement throughout that company. That'll be interesting to watch. You got Hut 8, so another miner, Wednesday before open. We've got Circle, what's going on with stable coins. Remember that run for a while?
Yeah.
That came back to earth. And then on after close Wednesday, I mean, it's NVIDIA, Trade Desk, Salesforce, Snowflake, IonQ, Synopsys, Pure Storage, and Nutanix. I mean, what a slate of tech companies. I mean, of course, it's like NVIDIA, right? You got more quantum Thursday morning with D-Wave. You got EOS Energy. Got after the bell on Thursday, you got CoreWeave. So that one could be interesting. And buddy, you got Rocket Lab Thursday.
I know.
Rocket Lab. Oh, and you asked about Zscaler. They're next week. Dell, dude, you're getting a Dell next week. They're always an interesting, bellwether on server demand. Duolingo, that's not so much of one I take seriously, but it's been a bit of a meme name. So, I mean, but seriously, what a week. I mean,
no, it's stressful. It's going to be a stressful one. I think that's what I made a comment earlier. Rest up this weekend because it's going to be one of those weeks where you're going to see a lot of movement. And I'm like so devastated that I only have a 3% cash position right now because there's going to be opportunity next week, in my opinion, with that many names, strong names reporting. But it's going to be every day is going to be something. It's going to be really interesting. It's going to be, if you're a fan of earnings cycle, like this is your Super Bowl. So enjoy it, strap down. But let's get some questions because I think we have I love the engagement, guys. We have a lot of questions, so I want to get to them as many as we have because we have.
I tried to kind of subtly answer some as we were going because, like, I do feel like sometimes it takes long and then people wait, and then they're sad because we don't answer them in real time. We see you. We see you.
We see you.
We see.
So this is a good one. Sales, ServiceNow, Adobe, Salesforce. What is your top pick out of those three stocks? I can give my solution, my answer. I think ServiceNow, if you want to go through the legacy layer test, I think ServiceNow has the most workflows that end in the physical real world outcomes layer. Like they have the laptop shipped, employees onboarded, tickets resolved. Like all of that really touches the physical world more than those Adobes and Salesforces out there. So I choose ServiceNow. What about you?
Well, if I put them in order right now, sadly for Adobe, it would be ServiceNow, Salesforce, Adobe. I'm worried about that new Google model that does
right.
Yeah. It's like Adobe just can't catch a break. Having said that, nothing has shown up in Adobe's numbers to indicate that it's actually in trouble. So this is one of those where I feel like they're vulnerable. But I also have seen zero proof in the physical world yet that that's actually happened.
Yeah, I agree. It's one of those names that are being priced as a legacy layer, but if it's not, explosive re-rating. Next one. You're right. I haven't seen these. There's a lot of Zeta comments.
They were selling with Zelda, man. Everybody's interested in Zeta.
So it's a very interesting one for me because I think they're trapped in two realities. I think their mode is obviously they do have proprietary consumer data. It's not just software workflows that are going to be at risk of being purely digital. Their AI does make targeting better. However, like, is that data proprietary enough for the outputs to remove the risk of all their output is digital? What I mean by that is obviously we're seeing signs that AI can generate ad copy, segment customers, they can optimize all these campaigns. Like if AI does commoditize the marketing automation layer, I do think Zeta's software could face pressure, but Zeta does own the actual, like their moat is the data. So I think that they're embedding AI into the platform to enhance the results, and it's clearly working. So the value is the data set, not really the workflow software, but I put it in the same category as ServiceNow. Is like you have to wait and see what they come up with for the next 6 to 12 months to see if their layer isn't going to become that legacy layer.
Yeah, I mean, the application of AI to deliver marketing outcomes is not trivial. Okay. What I mean is like you and I plugging some thoughts in and saying, give me 5 tweets to Claude is easy. Having it actually manage the marketing layer with all proprietary data, giving it, exposing it to kind of a campaign, a targeting info. There's a lot of work to be done. Like I said, like Claude will give you like the how to do it, but something that actually does it doesn't really exist in a fully baked. And it's always going to be weighing against like the DIY versus the kind of all-in platform that can just kind of take that for you and go. I think there's real value in that. Businesses don't want to be in the development game.
Yeah.
So if these softwares can be light, efficient, and quick to stand up and are agentic, I think people will pay for that. I just think people don't want old legacy marketing software with like we threw an agent on top of it. Like it has to truly, but I think I like that they're really trying to put ROI on AI. Mm-hmm. I think that's important.
Yeah, and they have a great story, and I think story matters a lot these days as well, especially in software. Next question. I think for me, I probably have to answer this one. The Rocket Lab, thoughts on the space theme. Guys, 2026 is still the year of space. Like, doesn't matter what the price action pullback like indicates. This is more of a risk off reason why all these space names are pulling back. But SpaceX going public at what looks like a $1.5 trillion valuation is uber bullish for the whole thing, because every component essentially of SpaceX's ecosystem will get re-rated because SpaceX is getting re-rated at this valuation. Yes, Starlink is the majority of their business, but we finally get the anchor of the whole ecosystem, what the multiple should be for that. And when you have the names like the Rock Labs are worth like $40 billion, I don't even know what their valuation is right now. I think that's to be the second source of the space economy and being only valued at $40 billion market cap when they're supposed to be growing at a 40% CAGR for next 3 years and hitting profitability next year. That screams, okay, that does not make sense to me. So there is an anchor, though, on Rocket Lab's earnings, which is there's going to be a delay on Neutron. And we don't really know exactly when that is. Neutron is their next catalyst to get that re-rating, next leg up on the stock price. And that is a medium-sized launch to finally really compete with SpaceX. That is the name of the game this year for Rocket Labs. That needs to not just have a final date, but also a successful delivery on that. But as of right now, I mean, it's digesting a bit. It's technically speaking, it looks like it's going to pull back in the near term even more. But it's holding up somewhat well. It's not holding up well. It's down 5% today. It's holding up above the 21-week EMA level. So that level is $66. So if it breaks that level, there might be some more pain. But yeah, I know you don't have much on that. Last topic, let's talk about memory. I think memory might be one of the bigger topics of NVIDIA's earnings next week. What's your expectations on that?
I think they've been more on top of this than others. I think they've bought more. Their size and scale is going to be a huge advantage for NVIDIA, like a huge advantage for NVIDIA. We know that all the memory makers are going to move memory capacity to higher value. Higher value is HBM. It's the data center. You're going to see this conversions multi-year. So this is going to work out really favorably. I've been saying good things about Micron for a long time. I feel very vindicated right now. Anyone that listened to me on this one has done quite well. But I don't think this is a short-term trend. I think this is a very, very long 3+ years. And then I don't think you're going to see the same memory bust as we historically did. We might see a memory normalization at some point, but I think it's going to stay elevated for longer. It's going to be a very robust category. Those that bought well, those that did spot pricing and thought they could save money by buying, kind of last minute, are going to get really, really screwed. And I think there's going to be a long tail of pain for a consumer, because you're going to see a lot of the memory, the capacity that was used for phones and for PCs is going to be reallocated to data center. And it's going to drive prices up. It's going to drive prices up, and it's going to drive availability down. And I do worry about some of like the PC businesses. I worry about HP a little bit. Lenovo's put out a warning on their PC business.
Qualcomm too. Last earnings cycle, Qualcomm.
On their, that's good that they're pivoting into data centers and robots, because the phone business is going to get hurt. And Apple warned about it. So Apple even had to warn, and Apple never gets supply chain stuff wrong. So I think it's caught a lot of people off guard, but I doubt it caught Jensen off guard.
Yeah. Like nothing does. He dictates the whole economy, in my opinion. But
that's it. That's all he's got.
That's all. Him
and God. Him and Donaldo Trump. By the way, we didn't really talk about tariffs, but I'll leave it here.
Oh, yeah.
I got to leave it because I got to get another call. This is going to be a multi-year mechanical exercise in the executive and the judicial branch, because they're going to just use another mechanism. And then the Supreme Court's going to have to go back and decide whether or not that mechanism for implement, because basically all they said is using the Emergency Act that he used was not, in this case, was a stretch of his powers. They didn't say tariffs are legal. They said the way he implemented them wasn't above board, or wasn't within his rights or within his powers. But now he can just find a new way to implement them. So I just think it's going to drag. So, all right, I got to run.
All right. That's us. It's all, folks. Hop in next week. Busy earnings cycle.
We'll be talking about the results of this mega cycle. We'll see you all there. Thank you so much.
See ya.